Today it's going to be all about earnings and the kind of global cues that we have at our hands, and that's going to shape up the Indian markets because yesterday there was a bit of a respite on the street. We managed to hold just around that 23,300 level, a bit of an uptick by the end of the trading session. But the big question is whether we'll sustain that bounce or not, because the FII selling has been relentless in the Indian market. We have seen selling to the tune of 40,000 crore in this month itself, and we're just 17 days into it. So that's something that one really needs to watch out for. Having said that, the global cues this morning are a bit mixed today. The US futures are steady after a downward session that we saw yesterday. The Dow, S&P as well as Nasdaq, all three of them managed to snap the three-day winning streak. Some of the tech stocks like Tesla as well as Nvidia, they were the ones that were coming under pressure. Apple too was down about 4% in the trading session. And US 10-year yield also actually retreated a bit. Not major cues basically coming in from the US markets as such. The oil prices, they have eased from that 5-month high level because at one point of time, the crude prices had escalated past the level of $82 to the barrel. They have come off a bit, but of course the street is watching out for the big event come Monday morning for the United States, and that's the swearing in of the new president, or actually the comeback of the president, which is Mr. Donald Trump, and that of course is the big talking point. Nikunj, we have been talking about Mr. Donald Trump since November and the kind of Trump trade that has already worked out. Do you anticipate a further such Trump trade or to play out in the next couple of weeks as well?
You know, I can only share what I've learned over the years, which is that you buy the rumor, sell the news. I think the long-live dollar trade or the welcome back Donald Trump trade is reaching its climax. See, there has to be a logic, there has to be merit, and then there has to be a economic thesis why flows should gravitate back into US. If the assumption is that okay, US economy, which is doing rather well, will suddenly accelerate in the next 2 years or next 1 year because of the change of administration, will higher tariffs ensure that America in a sense continues to chug along strongly and the rest of the world goes down? If the assumption is that the flows will only gravitate to dollar denominated assets and that trade will continue endlessly, those are factors which frankly beyond a point are not likely to extend. So globally, while everybody is talking about long live the dollar and US dollar is the pivot where US dollar denominated assets is where the flows are moving, I expect it's a matter of time that this trade will peak out. It could happen this week, it could happen in coming week, it could happen in next 1 month. But it's time now to start looking at the other side, which is that where there is value, who will benefit if the dollar reverses? And in this market where there are spots of stress now, how do you start treasure hunting? I would use the word treasure hunting. Some would use the word nibbling. Some would use the word contra buy. But I'm sticking my neck out and consciously saying it's time to treasure hunt the market.
Yeah, because there are those positives which are now building in the markets as well. And even for us, you've seen the inflation print ease out. You are seeing very strong DI flows irrespective of the quantum of the FII selling. And earnings so far are not disappointing. They're largely mixed, one would have to say. Of course, we're going to be reacting to many of those today morning.
See, in the near term, when a trend becomes large, everybody only talks about it. Like we started the show talking about the Trump trade. And that is what is happening in the market. In terms of the psychology, everybody just thinks that FIs will continue to sell, mid caps will continue to shrink, and small caps will continue to remain on the butcher block. It is quite a reversal of what we saw, let's say, same time last year or 6 months ago, where everyone thought that small and mid cap stocks will continue to move higher, SMEs will continue to fly, and the ringa roses will continue IPO market. So that, I think, has changed. Rather than a rising tide phenomenon where everything was going up in a synchronized manner, now 20-30% of the market is looking attractive. 20-30% of the market may stop falling, and 20-30% of the market may not go anywhere and could remain with a downward bias. So I'm not saying that you buy everything. It's not a market where you can blindfold yourself and say, okay, I'm going to buy. No. It is time now to start buying that value or start buying stocks which you understand. And you're absolutely right, Aisha. What are the positives which you're ignoring? Numbers have not been bad, frankly. Inflation is coming down. SIP flows, they continue. and a lot of bad news, which in a sense, a lot of excesses which had got created in the F&O market, they seem to be also coming under check. So if we get a little bit of help from the global market, reversal in the dollar, some reversal coming back into emerging market equities, we could be looking at a very different second half of January. First half was all about selling, volatility, but there are again excesses in the market which have got created, and I would say not everything will go up, but not everything will go down. See, it's very simple. I'll explain it again, or I'll try and explain it again. It was a rising tide phenomenon between 2023 and 2024. You touched the stock, it went up. Didn't matter as long as it was small cap and as long as it was a mid stock. Now, 20-30% of the market will start rising. That's a value has come. 30-40% of the market will stay where it is because it has already corrected, excess is out, and 20-30% of the market will trade with a lower bias. You want to beat that first part, that 20-30%. So don't ignore this setup in the market environment right now to miss on that 20-30% part.
Okay, so that's the take coming in as far as the market setup is concerned. But just taking a look at what happened in the Indian markets yesterday, because we managed to gain as far as 3 consecutive sessions are concerned. It's the PSU banking index that was doing quite well in the trading session as well. But of course, it was IT which was under pressure. And today, I think IT will be under further pressure if you go by what Infosys ADR actually managed to do overnight. A dip of almost 5% coming in despite the guidance upgrade coming in from Infosys for the third straight time. A beat on top line. Good show on margins, beat on profitability, decent numbers. But then, of course, begs the question why the ADR was down. Well, A, the quality of earnings with the pass-through earnings coming in. And secondly, of course, the fact that the stock has run up. But what will support the sentiment today perhaps is going to be Reliance. What a great show coming in from Reliance, both in terms of the retail business as well as the refining business. That's something which is expected to negate the effect of Axis Bank today, because Axis Bank, the credit cost was on the higher side, slippages were on the higher side. And the management commentary also talks about a tough macro environment. Nikunj, seems like it's going to be a tug of war between Reliance versus Infi and Axis.
So let's address Reliance. And Anisha, it's not the numbers are bravo, but it's just that stock has underperformed so much that little bit of incremental change on areas where there has been stress, I think is something which may just do the trick for the market. The retail business is coming back and OTC segment is looking decent. The stock has underperformed. It is cheap now. It is just, when a stock is underperforming, when it is cheap, and when there is a hope and an evidence that the turn in the numbers is something which is visible, the stock, it could outperform. And I think that's Reliance for you. Brokerages across the board, they've said a thumbs up. Some have said double thumbs up. I think across the board, brokerages will put out that number. They've also upgraded their target for Reliance. So needless to say, an underperforming stock, but a heavyweight Reliance really holds the key. Infosys, completely different kettle of fish. Very different in terms of the approach. Stocks outperformed. The stock had hit a relative, it was almost at a new high at the end of December and the beginning of Jan. There's nothing bravo which will justify an earnings massive upgrade, but the positioning of the stock is such that if you're thinking 3 months out or 6 months out, this entire dollar tailwind is going to be missing. So if you are able to see 3 months out and say, okay, the business is looking okay, the stock has run up, psychological tailwind which the stock enjoyed because of the weakness in the currency, if that changes, is IT a buy now? As it is, globally, US tech stocks have started correcting. We've seen what's happened to Apple, we've seen what's happened to Nvidia, we've seen what's happened to Cognizant. So if there's a crunch in global stocks, which is technology, you cannot compare them, but tech psychologically, fall in US stocks will have impact in Indian stocks. Where Rupee is headed in terms of the strength, what numbers are and where the valuations are, you would say Infosys may just struggle at these levels and the bias could be downward. And Axis Bank, I think I'll give them benefit of doubt, Anisha, because that they've demonstrated excellence in last couple of quarters. Last quarters, they're blaming it on seasonality. The stock had a different reaction same time a quarter ago. It could be a different reaction today. But I think for Axis Bank, buyers could come back at lower levels because with private banks, they're cheap. And the 1 year visibility or the 6 month visibility is certainly better for them.
If you like this video, then like, share and subscribe to ET Now.